Welcome to this topic, capital budgeting. We shall be considering capital budgeting under the condition of certainty. That is, we shall be considering capital budgeting with certainty. Capital budgeting has to do with how to allocate resources. Capital budgeting has to do with how to allocate resources to investment opportunities. The main logic behind capital budgeting is the decision to invest in business opportunities that is more valuable than what such opportunities cost. Since we have noted that the main logic behind capital budgeting is the decision to choose the best investment opportunity that far outweighs its cost. So therefore, we will now begin to look at the techniques for taking these decisions, the techniques that will be employed to analyze these business opportunities so that the decision can be taken. There are 5 techniques in analyzing the decision. The first one is the payback period. The second one is the accounting or average rate of returns. The third one is the net present value method. The fourth one is the profitability index method. And the fifth and final one is the internal rate of returns. The first technique is the payback period, which means the length of time it will take the project to recover the initial cost. It means the length of time it will take the project to recover the cost that was invested in the project. The way to calculate it is to add up all the cash inflow, to add up all the revenue until the initial cost is attained. As an example, we assume that there are 2 projects, project 1 and project 2, that are under consideration. For project 1, the initial cost is 2,005. For project 2, the initial cost is also 2,005. For project 1, the revenue in year 1 will be 1,000, the revenue in year 2 will be 1,008, the revenue in year 3 will be 3,000. For project 2, the revenue in year 1 will be 1,002, the revenue in year 2 will be 600, and the revenue in year 3 will be 2,005. Now, what is the payback period? Like we said before, the payback period is the length of time it will take for the project to recover this initial cost. The length of time it will take to recover the initial cost, and we achieve that by adding the revenue until we get the value of this initial cost. To determine the payback period, we take the initial cost, which is 2,005, and then for year 1 the revenue is 1,000. If we recover 1,000 from 2,005, we have 1,500 left. For year 2, we have a revenue of 1,800. And now we realize that the revenue of 1,800 in year 2 is higher than the 1,005 we want to recover. So how do we know how long it will take us to recover? At what point of making this 1,008 are we going to arrive at 1,005? That point will be at 1,005 divided by 1,800 times 12 months that make up a year. That should give us 10 months. So therefore, it means that the payback period for project 1 is 1 year, and 10 months. For project 2, the initial cost is 2,500. In year 1, we recovered 1,200, meaning that we have a balance of 1,300. In year 2, we recovered 600, meaning that we have a balance of 900 deficit. In year 3, we recovered 2,500, which is higher than the 900. So what we do is to divide 900 by 2,005 and multiply by 12 months that make up a year. Now for project 2. For project 2, we have an initial cost of 2,500, and then in year 1 we are able to recover 1,200. We have a balance of 1,300. In year 2 we are able to recover 600. We have a balance of 700. Then in year 3 we are able to recover 2,500, which is higher than the 700. So what we do is to say 700 divided by 2005 times 12 months. That will give us 3 months approximately. So therefore, the payback period for project 2 is 2 years and 3 months. So judging from the 2 calculations, it will be advisable to pick project 1, which has a shorter period of recovering the initial cost. The limitations of the payback period is that it overlooks the profitability of the project because it does not consider the entire lifespan of the project. Also, another limitation of the project is that it is a crude way, it is a crude technique. Another limitation of the payback period is that it does not consider the time value of money. The third limitation of the payback period is that the cash flow, the revenue pattern, can influence the calculation of the payback period. The second technique is the accounting or average rate of return, which is the average revenue or average profit divided by the average investment, which means that the money generated from the investment, the average of it divided by the average cost of undertaking that project. How to get the average revenue is that you add up all the revenues over the lifespan of the project, subtract the initial cost, and divide by the number of years. You add up all the income or all the revenue that the project will generate. You add it up, subtract the initial cost from it, and then divide by the number of years. That will give you the average profit. And of course, average investment is the initial outlay divided by 2. As an example, let us assume that you have a project that will last for 5 years. So the number of years is 5 years with initial investment of 2 million. Initial investment is 2 million, and annual revenue or cash flow is 600,000. 600,000 per annum. This will mean that every year, year 1, year 2, year 3, year 4, year 5, every year the cash flow or revenue is 600,000. Every year the income is 600,000. Every year the income is 600,000. So to get the average profit, what we do is to add up all this income. That gives us 3 million. Then subtract the initial outlay, which is 2 million. That gives us 1 million. So average profit is 1 million divided by the number of years, which is 5. So if you divide 1 million by 5, you have 200,000. So average profit equals to 200,000. And then average investment is the initial outlay divided by 2. That's 2 million. Divided by 2, that's 1 million. So the accounting or average rate of returns is average profit divided by average investment. That gives us 200,000 divided by 1 million times 100 to make it percentage. So if you divide 200,000 by 1 million and multiply by 100 to make it percentage, it means that the accounting rate of return will be 20%. The limitation of the accounting or average rate of returns, just like the payback period, is that it also does not recognize the time value of money. But the advantage of average rate of returns or accounting rate of return over the payback period is that it takes account of the full lifespan of the project. It takes account of the full lifespan of the project, and the pattern of revenue does not affect it in any way. The third method is the net present value method. The net present value method helps to make all decisions about all choices or all decisions about investment analysis valuable. Just like the name says, the net present value, it helps to make all decisions about investment valuable, such that the time value of money is taken into full and proper consideration. The steps involved in net present value is to, first of all, determine the revenue that will be generated from the investment opportunity, and also determine the cost that will be expended on the investment opportunity. The second step is to determine the lifespan, the duration of this investment opportunity. The third step is to find the appropriate cost of capital, or the discount rate that will be used to evaluate this project. The fourth step is to use this appropriate discount factor to discount the revenue. And the fifth step is to add up all this discounted revenue, while the final step is to then subtract the initial cost from this added discount revenue. The appropriate discount rate is the return on securities or opportunities that has the same risk as the project that is being considered. The appropriate discount rate is the same thing as the return on other securities that has the same risk with this investment that is being considered. This discount rate measures is the choice between investing in this project or taking your funds to go and invest in other viable projects. So what this discount rate measures is the choice of either investing in this opportunity or seeking investment opportunities elsewhere. The advantage of the net present value method is that it is not affected by other existing independent projects. Now, as an example, you have the opportunity to invest in two different projects, Project 1 and Project 2. Project 1 has an initial cost of 1 million. Project 2 also has an initial cost of 1 million. Project 1 and 2 both has 5 years duration. The revenue for Project 1 is 150 in year 1, 280 in year 2, 350 in year 3, 400 in year 4, and 320 in year 5, while the revenue for Project 2 is 140 in year 1, 265 in year 2, 345 in year 3, 380 in year 4, and 300 in year 5. The discount rate for both projects is 12%. So, using MPV, which of the two projects, the question is, using MPV, which of the two projects will now be viable? So, in solving the example for Project 1, this is the column for the years, the revenue column. In the initial cost of the project is 1 million in year 1, 150,000 revenue, 280 in year 2, 350 in year 3, 400 in year 4, and 320 in year 5. The discount factor, we are told, is 12%. So if you calculate the discount factor, which is 1 plus R raised to minus N from year 1, for year 1 it is 0.82 to 89.29 and so on up to year 5. Then to get the present value, you multiply this and this, it gives us 1 million. You multiply this and this, it gives us 133. So we can say this, I can label this A, B, and I can say this is C, which is equal to A multiplied by B. So this times this gives us this, this times this gives us this, times this gives us this and this, this and this. So the next step is to add up all the present value of the discounted cash flow. That gives us 1,042,049. Then the NPV is then you subtract the initial cost from the added present value. So the NPV will then give us 42,049. The NPV for project 1 will be 42,049. For project 2, we still construct the table and then put the values. For year 1 is 140, year 2 is 265, year 3 345, year 4 380, and year 5 300. To get the present value of the discounted cash flow, you multiply column A by column B, which is this times this, this times this, this times this, this times this, this times. Having multiplied, I've gotten the values. The next thing is to add up, to sum all this value of the discounted cash flow, which gives us 993,545. Then subtract 1 million from this, we have 6,455 negative. Meaning that from the net present value technique, this second project 2, is resulting in a loss of 6,455, while project 1 is resulting in a gain of 42,000. So using the net present value technique, it will be advisable to choose project 1 and reject project 2. The fourth technique is the profitability index. Profitability index is the fourth technique, which is also the value investment ratio or the profit investment ratio, because it shows the ratio of the relationship between the revenue or between the profit and the cost. It shows the ratio of the relationship between the revenue and the cost, meaning that, and it is calculated, the steps are taken exactly the same way like the net present value, but the difference between the profitability index and the net present value is that at the end, unlike the net present value that wants you to subtract the initial cost from the sum of the discounted cash flow, in profitability index, instead of subtracting, what you do is that you will divide the sum of the discounted cash flow by the initial outlay. So profitability index in this example, for instance, will be a division, not subtracting. Will be you divide that will give you 1.04. So the difference is that instead of subtracting the initial outlay from the sum of the discounted cash flow, in profitability index, you take a ratio by dividing the sum of the discounted cash flow by the initial outlay to get a value, a ratio value. The decision rule is that the higher the profitability index, the more acceptable the project. The higher the profitability index, the more acceptable the project. And what the profitability index technique does is that it measures the project per unit investment. For every unit investment, for instance, this investment is costing 1 million. The NPV measures the totality, everything together, while profitability index measures this project for every 1 naira invested. For every 1 naira invested. So the interpretation of this profitability index is that for every 1 naira investment, 4 kobo profit is made. For every 1 naira investment, 4 kobo profit is made. The fifth and final technique is the internal rate of returns. The fifth and final technique is the internal rate of return. The internal rate of return is the discount rate that makes the net present value of the project to be equal to 0. So therefore, the internal rate of return uses the same technique as the NPV. And the internal rate of return that is greater than the discounted factor is most appreciated and most acceptable. So So as an example, under the internal rate of return, we assume that you have the opportunity to invest in a project with the following returns. The initial cost is 1 million. The number of years or the duration of the project is 5 years. The revenue is year 1, you make 150, year 2 make 280, year 3 350, year 4 400, year 5 320. You are now asked to find the internal rate of return. Like we said before, the internal rate of return is determined by calculating the technique for determining the internal rate of return. Is the same thing as the techniques for calculating the NPV. In solving this, we'll be using the NPV method. So we will need to calculate two NPVs. One of them must be positive, one must be positive, and the other one must be negative. So we need to calculate two NPVs. One must be positive and the other one must be negative. But to calculate the NPV, so we have seen from this question that the discount factor is not given. Discount factor is unknown. And you know that in calculating NPV, discount factor is required. But in this example, discount factor is not given. So what we do is to take a guess. We will take a guess, and with that guess, we must find an NPV that is positive and another one that is negative. After determining those two NPVs, we will then interpolate. By interpolating, we will arrive at our internal rate of return. Now, like we said, the discount factor is unknown. So what I have done is to take a guess, and I took a guess of 10%. I decided to work with 10%. You can take whatever guess you like. You can work with whatever discount factor you like. But the point is, when you interpolate, all of us will arrive at the same answer if we are correct. Working with discount factor, working with a guess of 10%, and I've calculated the discount factor of the 10%. Then to get the present value, multiply this and this and this and this. It has given me this value. I have then added all the discounted cash flow to get 1,102, and then to find the NPV, remember that we have to subtract the initial cost from the added discounted value. So the NPV has given me a positive of, I have gotten a positive NPV of 102.63. Having gotten this positive NPV of 102.63, I now know that I need the second NPV, which has to be negative. So what I will do to get the negative NPV is to guess another discount factor. Guess another discount factor. This time a discount factor that is higher than this 10%. I will get 15%. So I am taking 15%. The point is, since I guessed 10% and it gave me a positive NPV, I now know that the next NPV I'm looking for is the negative NPV. How do I now get the negative NPV? The way to get the negative NPV is to take a second discount factor that is higher than the first one. Had it been I got a negative NPV here, I would have taken a discount factor that is lower than this 10%. Had it been, let me repeat that, had it been I got a negative NPV here, I would have taken a discount factor that is lower than this 10%. But since I got a positive NPV here, so what I will do is to take a discount factor that is higher than this 10%. Now I have taken the 50. I have decided to take 15%, you may take 18%, you may take 20%, you may take 14%, you may take whatever percentage, but be careful that the gap between the two percentages is not extremely too wide. So let me now determine the discount factor of 15%. So I have determined the value of the discount factor at 15% for year 1, year 2, year 3, year 4, year 5. And then I have multiplied this value by the revenue, 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 this value by the revenue to get this. And then I have added the sum of the discounted values to get 960.08. So to get the second NPV, I will subtract 1,000 from 960, and that gives me 39.92 negative. That gives me 39.92 negative. So now I have gotten one MPV that is positive, and I've gotten one MPV that is negative. The next thing for me to do now is to interpolate. Now that I have gotten the two positive the two MPVs, one positive and one negative, and I've gotten and I know the discount factor that gave me these two MPVs, the next thing for me to do now is to interpolate. By interpolating, I will get my IRR to be the discount factor that gave me the positive MPV plus the positive MPV divided by both MPVs added together, MPV1 and MPV2. So I call the positive MPV MPV1, I call the negative MPV MPV2. Then multiply by discount factor, I call the positive discount factor 1 and this negative one 2, discount factor 1 minus discount factor 2. So what I have here is the discount factor 1, which is the positive discount factor 10%, plus the negative MPV1, which is the positive MPV 102.63, divided by 102.63 plus 39.92 multiplied by 15% minus 10%. You will notice that here I disregarded the negative sign of the second MPV. I disregarded the negative sign of the MPV that gave me negative. So what I'll have now is 10% plus 102.63 divided by, if you add these two together, then multiply by, if you subtract 10 from 15, you have 5%. If you add these two together, it gives you 142.55. So from here, I follow the simple rule of BODMAS. Where there is no bracket, I can remove this. There is no bracket, there is no off. The next thing is division, so I divide the two. I divide this by this, and then once I finish dividing, whatever answer I get, I multiply by 0.05. Whatever answer I get, I add to 0.10, and that gives me 13.6% as the internal rate of return. Thank you very much for listening to this topic on capital budgeting under the condition of certainty.